Hello, I'm Mark Dunne, the editor of Portfolio Institutional Magazine. Regular viewers of this portfolio briefing series will know that we take a close look at an investment market, and this time we're looking at ESG in the emerging markets. A lot of the world's growth is forecast to be driven by companies in developing nations in the coming years, and such growth, of course, is attractive to the developed world. So the question is, with ESG being so popular among developed market investors, where does it fit into the emerging markets? To find out, I'm joined by Kathryn Langridge, who is Senior Portfolio Manager, Head of Emerging Market Equities at Manulife Investment Management. Hi, Kathryn.
Hi, good morning.
Morning. And Eric Nietsch, who is also from Manulife Investment Management, where he's Head of ESG Asia. Thanks for joining us, Eric.
Thank you, Mark.
Good. I think a good place to start. Developed market companies are constantly updating investors on their ESG performance or some of the metrics within the ESG world. How popular is ESG among companies in the developing world? Kathryn, if we could start with you.
It's a subject that has increased in prominence in recent years, obviously encouraged by a wider development globally. And I think that across emerging markets, there is increasing realization of the importance, not just of engaging with investors on the subjects of ESG, but much more importantly, incorporating aspects of ESG risk management in their own businesses. And so the importance of ESG, I think, is increasingly widely recognized. Obviously, it has very varied effects. There are companies that really get it, companies that have spent many years improving not just their management of these risks, but also how they talk about it, how they explain it in their annual reports and so on, and the levels of engagement that we can have with the best quality companies in emerging markets. There are others that simply don't get it, and there's lots of variation in between.
Gotcha. And Eric, do you have anything to add?
No, I would agree with what Kathryn said, and I think one of the challenges that we sometimes face is sometimes we look at a variety of different markets, and in those different markets, when the companies are trying to communicate what they're doing, sometimes they use different frameworks. So we'll have to understand those different frameworks, whether it's all the different acronyms, GRI or SASB, or whether they're looking at the Sustainable Development Goals and the SDGs. And so those different frameworks have different levels in different parts of the world. And so we have to take them all and pull them apart and look at what's most important.
Gotcha. Okay, now in the developing world, agriculture is quite important when you think about the impact that climate change is having on the planet. And of course, we also read about forced and child labour in the developing world. So are ESG risks higher when looking at emerging market countries or companies than, say, in the developed world? Eric, could we start with you this one?
Sure. So I think why don't I answer this question from the region that I look at, which is Asia. So if I think about Asia, there's probably more people and more environmental pressure in the region than there are in other parts of the world. So Asia has almost 2/3 of the world population, produces about half of the global greenhouse gas emissions, and that population is relying on only about 1/3 of the world's fresh water. So to answer your question, there are definitely substantial risks and challenges in the region. That said, the fundamentals that are contributing to those challenges, so the growing population, the rising middle class, the high rates of economic development, that's also what makes the region so attractive from an investment perspective. So as these companies are growing, they're having an impact on the environment and society and the many people that live in Asia. And so that creates a strong case for ESG investing in the region. If identify the companies that are addressing those risks and contributing to solving them.
Okay, and Kathryn, looking at the wider emerging markets.
Yes, I mean, there are very clearly identifiable environmental risks, whether we think about deforestation across Latin America, the destruction of the Amazon rainforest and so on, whether we think about the melting of the permafrost in the Arctic Circle and the impact that has had on most recently and publicly on one of the major Russian gas companies. So our job as basically as stewards of other people's capital is to identify the companies that are best positioned to manage those risks, that really understand the importance of engagement with their communities. For example, were we to invest in a mining company in Brazil, we would have to satisfy ourselves that they were operating at the very highest standards. And I have to say there have been some very well publicized transgressions there. The recent tailings dams incidents, for example, at Vale in Brazil, very well-known public disaster. So these are examples of material risks that can impact the companies in our investment universe. And it's our job to identify those risks, identify those companies that are not managing them effectively, and to avoid them.
You said there that you're stewards of your client's capital, but could you tell me a little bit more about how you're integrating ESG into your investment decisions?
Yeah, I've been investing in emerging markets for 40 years, and I have to say that one of my very earliest lessons in emerging markets investing was to identify at a very early stage corporate governance issues, because quite frankly, poor standards of corporate governance can completely destroy an investment thesis. So that was really one of the most formative influences on my early career in Asia in the 1980s. And it is true, I think, that aspects of governance and the alignment of shareholder interest is an absolutely critical part of analysing companies and identifying companies that will reward us as minority shareholders. So identifying governance as a principal issue that was essential to understand has been something that's embedded in my investment approach for many years. I think more recently, I'd say over really the last decade, the rise of significance of the other aspects of ESG, that is social and environmental issues, and coming to understand the impacts that these challenges present to companies is equally important, because for us, all we're trying to understand is whether a company can grow and beat its cost of capital over time, and that we can identify the best quality companies that will deliver those returns to us as minority shareholders, and where there are any risks in terms of environmental, social or governance that imperil that investment thesis, then we won't invest. So it goes therefore without saying that these issues are incorporated at every stage in our investment process, from idea generation through forensic due diligence in terms of the company research, through to final portfolio construction, whether we should own a company, and at any stage, if we think that the risks are sufficiently material that they imperil the investment thesis, we simply don't invest. There are plenty of good companies in the emerging markets universe to be able to knock out with conviction those that we can't build a conviction thesis around the sustainability of returns.
And Eric, do you have anything to add on the investment process there?
Well, I can give you my perspective from working on the ESG research and integration team, which works with Kathryn and her team, but also some of the other investment teams across Manulife. And so what we find is there's no kind of one size fits all solution for every team. But what we're looking for and what we're working on with the ESG integration is to make sure that these topics are integrated throughout all of the steps of the investment process. So starting with the data sourcing, and then the research and the security selection, as well as the portfolio construction, and then our engagement with companies once we do own them. And so that's, in terms of answering the question about being stewards of our clients' capital, we're looking from a perspective of financial materiality. So trying to identify the environmental, social, and governance issues that can affect the investment returns. And that can take different forms. So that could also include how companies contribute to and are affected by systemic risks, which our clients might care about, and evaluating those, and then sharing our perspective with the companies and encouraging them to improve their performance on those issues.
Yeah, I would also highlight the importance of engagement with companies, not just as we come to understand their approach in relation to these challenges and opportunities, but also in terms of active ownership. So when we invest in a company, we would expect actively to engage with the management and to work with them or encourage them in terms of both improving how they publicize the work they're doing in ESG. Very often the story is not well told by the companies, and so we can help them identify that as an area for improvement, but also in terms of materially, where there are risks that we think that they should be working to improve. Also creates opportunities for us, because when we can see that a company is actually working to improve these aspects and the market doesn't yet know about that, or rather that is not understood in the market, we think there is a valuation opportunity there. So these are incremental things that we can work on that actually, again, as stewards of our investors' capital, work to improve the value of our investments.
So you're working with developed market companies. So I mean, from what you're saying, it seems to me that they've been quite receptive and they're open to change to secure capital.
Well, as I say, it varies enormously. So there are companies that just don't get it, never will, and we wouldn't invest in them. But I would say that over the last 20 years, if you were to ask me if there have been material improvements in corporate governance, transparency, engagement, openness, understanding about environmental and social risks, I would say yes, the trend is very clear. And the companies that get it realise that they will attract a higher valuation as a result. They will have better access to capital. They will attract a wider investment base and investment constituency. So it's a positive, self-reinforcing circle, and the best companies understand that.
Okay. And Eric, what about something in Asia? Are directors very open to change, or is it, as Kathryn says, a different case-by-case basis?
Well, it is a case-by-case basis, but more often than not, we find that companies are willing to meet and have conversations with us. And the way that we approach engagement with companies is usually collaborative and supportive. So once we've made the decision to invest in a company, if we see an issue at that company that can be improved, we can share that perspective with the companies. And from our perspective as investors, we're looking at many different companies in many different sectors, and so we can share a perspective that can be helpful to them, and ultimately, if they can improve their performance on that topic, whether it's mitigating a risk or taking advantage of an opportunity, that can help the performance of the company, which can in turn support the performance of our portfolios and ultimately benefit our clients.
You've both mentioned governance during this conversation. How would you rate the standard of governance in emerging markets when compared to in the developed markets? Kathryn?
Well, first of all, I would say that emerging markets do not have a monopoly on poor standards of corporate governance. The recent Wirecard scandal is a good illustration of the fact that corporate governance scandals exist globally, and tragically, I suppose it's part of the human condition. So when corporate governance issues come to the fore in emerging markets, the conventional response is, well, that's what happens in emerging markets. I don't think it is any more common in emerging markets than it is in the developed world, frankly. But the publicity is always very unwelcome. I would also say that when these scandals do break, there is invariably a long history of red flags. These things very rarely appear out of nowhere. Most recent example, I think, Luckin Coffee, an ADR in the United States. Now, there are always signals in terms of accounting, the numbers behind in the accounts that just don't quite add up. There'll be issues in terms of managements that aren't are clearly putting their interests ahead of those of the wider shareholder base. There are always red flags, and so I don't think that. I just think it comes back to the importance of knowing your companies, of undertaking proprietary research, also the importance of common sense. Very often these things are there in plain sight, but because of the momentum in markets, then the herd instinct that takes over as these share prices go up and up is something that attracts people who don't actually think about these issues in any depth. So, the importance of common sense should never be underestimated.
Same question to you, Eric.
Sure. So, I think Kathryn covered the important issues in emerging markets, and so I'll try and just touch on some of the aspects in Asia. In Asia, I think we see a higher proportion of companies that are either majority family-owned and controlled or state-owned and controlled, and so we place a lot of emphasis on really taking an active approach to analyzing the incentives of those governing structures and looking at related parties and related party transactions and the track record of those management teams. And so, I think that's a difference in the region. I'm not sure that I would say that the risks are higher, but those are some of the different topics that we try to address.
Gotcha. Okay. Of course, when assessing ESG performance or profile of a company, data is key. So, what's the quality of the data you guys are getting? I mean, Kathryn, you did say that some of these companies are doing this work; they're just not blowing their own trumpet about it.
Yes, that's right. Now, we subscribe to a number of external rating agencies which give us some insights, but again, coming back to the importance of doing your own work and understanding the risks for yourself is absolutely critical, because even looking at the assessments of the rating agencies, there are huge variations. So, what is a triple C company to one could be a B+ company to another. So, the information that goes into the rating agencies, sometimes there are timing differences. So an accident, for example, might have occurred 3 years ago, which will be in somebody's data, but not in somebody else. That can lead to an altogether different outcome. So there are all sorts of, under the hood variations in the information. You just have got to do the homework yourself.
And Eric, what about the quality of the data you're seeing in Asia?
I think there are challenges with the quality in the data. Sometimes the companies can disclose different things. Even if they're disclosing on the same topic, they might be disclosing different metrics or measuring them in different ways. And so, that's where I think it's really important to have those relationships with the companies that Kathryn mentioned, and to have that strong research process to understand what's going on at the companies and to make sense of the data that we do have and to make intelligent decisions about the gaps in the data. But that said, we have a lot more information than we did a few years ago, and that's what allows us to do new and more incremental and additive things with the ESG analysis. And the other thing that I can mention, moving a little bit aside from the investment process, is as a firm and as a ESG research and integration team, we can work with industry bodies that are trying to work on standardizing the disclosure and making it easier for companies to report. We have some projects where we're exploring natural language processing and different technology tools that can help us to fill in some of those gaps. And so there's multiple ways that we're approaching it as a company.
Yeah.
Finally, should investors be cautious about backing companies that have got quite significant state ownership as a shareholder? There's, of course, the risk, they could be more influenced by political goals rather than ESG performance. Eric, we'll start with you.
Well, I think anytime we're looking at a company, it's important to understand who owns it, who controls it, and what their incentives and track record are. So, I think that's certainly the case. That's the case when we look at any company. It's the case that when we look at state-owned companies. And so it's, I think it's definitely
Kathryn?
something that we consider.
Kathryn?
For us, it's all about the alignment of shareholder interest and whether returns will accrue to us as minority shareholders. So if we think that a company's primary interest is the state, or indeed the interest of the family, because remember, there are a lot of, we've got two issues in terms of concentration of ownership in emerging markets you need to think about. One is state-owned, and the other is the dominance of family interest. And both of these things actually can add up to the same conclusion, is whether returns will accrue to minority shareholders fairly or not. So you look to track record, you look to just how powerful those interests are and whether they're going to warp the return profile, and you make an investment decision accordingly. But where a company is clearly going to be first and foremost the instrument of the state and a national champion, then it's pretty clear that capital allocation decisions will not prioritize the minority shareholder, and we would avoid those companies.
Gotcha. Kathryn, Eric, it's been great talking to you. Thank you for your time and, of course, for sharing your thoughts with us. And given the circumstances, I hope that you both stay safe. So thank you.
Thank you. Thank you so much, Mark. Thank you. Good to talk to you.
Thank you, Mark.